Hello friends, this is your commerce friend CA Yogesh Panchakshari. Today's menu is the revision of admission, retirement and death of partner. Is it really possible to revise all these three headings in one video? Let's see. I think it is yes. So let's see how to go for admission, retirement, death and its steps. So let's start with the admission of partner. See, there are specific steps to admission of partner and the same steps you can use for retirement and death also. Let's see this question. A and B are partners sharing 3:2. Balance sheet is given, capitals, then bank overdraft, loans, creditors, bills payable, other liabilities, building, car, investment, debtors, BR, stock, other assets and bank. And C is admitted, who will get 1/4 share and he will bring some cash. Some assets are revalued, some asset and liabilities taken over by partner. Goodwill value is given. Goodwill is to be raised and written off, and new capital to be in the new ratio based on Mr. A. So it's a unique question. It's the best question to go for revision. So what are the steps to go for? First, prepare. So these are the steps. You can take the screenshot of these steps if you wish to. So the step says you should prepare the revaluation account, capital account, bank account and new balance sheet first. Then transfer past profits, losses, reserves to old partners in old ratio and record balances to all the accounts. Let's go for it. Firstly, I will prepare revaluation account, capital account, bank account and balance sheet. Then I will record the bank balance as well as capital balances. And then I will transfer general reserve or whatever reserve is there to the old partners in old ratio. As it was not there, so you can skip it off. Then comes the next step, that is record the cash brought in by new partner. That is bank account debit to Mr. C's account because he has brought some capital 1,40,000. Second effect to his capital account credit side. Next step is to make the revaluation of asset and liabilities. So all the assets which are revalued, as you can see in the balance sheet asset side, building appreciated, second effect revaluation credit, car reduction, second effect it's a loss, so revaluation debit, debit all expenses and losses. Then investment reduced by 10%, so revaluation debit. Then bills payable reduced by 20%, it's a gain, so revaluation credit. Next step is take the record the assets or liabilities taken over by any partner, like investment is taken over by B. So debit the receiver, B's account is debited to investment account taken over. Bills payable is paid by A. So it is reduced from here. So it is 0 now and it is credited to A's capital. That means right now A will pay it off and afterwards he will get it back from the firm. Next step is to record revaluation expenses, bank account debit to revaluation expense account. Second effect will go to the bank account credit side. Next step comes find out the new ratio if not given. So we'll go to the working note, and as you know, there are a variety of adjustments for new ratio as nothing is given. So they will sacrifice in the old ratio 3:2. So original ratio was 3/5, 2/5. C will get 1/4, which will be sacrificed by both in their old ratio. When nothing is given, old ratio is sacrifice ratio. So this is reduced from their ratio. You got the new ratio 45:30:25. That is 9:6:5. So we got the new ratio. That was the step. Next steps comes find out goodwill. Goodwill amount is already given to be 3 lakh. Then raise and return of the goodwill. That means goodwill raised, old partners, old ratio, goodwill account debit to A to B. Goodwill written off, new partners in new ratio. ABC, that is partners of new firm in the new ratio. So goodwill cancelled. So we'll give the credit effect to capital accounts by goodwill account raised and written off to goodwill account. So what is the effect of raise and written off? The amount of 75,000 is removed from C's account and given to A and B in their sacrifice ratio. So it is automatically done. You don't need to worry about it. Simply raise the goodwill in old ratio, write it off in new ratio. You got the perfect effect. Then transfer revaluation profit loss to old partners in old ratio, that is A and B will suffer this loss. Then make the capital adjustment if any. It is given that A's capital will be the base. So I found the balance of A's capital and that comes to balance 1,39,200. Now A requested B and C that you should keep your balances in the new profit sharing ratio based on my balance. So here is the working note. A's closing the balance is 1,39,200. Their new ratio is 9:6:5. So if for 9 it is 139,200, for 6 how much and for 5 how much? Cross multiplication will give you the balance. So this is expected closing balance of B and C based on A's balance. So this is recorded in the capital account on the debit side to balance carried down, immediately recorded in the balance sheet. These are the expected balances. But it doesn't mean that they must be having the same balance. So what we will do is we'll find out the balancing figure that will go to bank. So if you are having excessive cash, you can withdraw. If it is short of cash, you will bring some cash in. So this is balancing figure of B and C's account by bank. So bank account is debited with this amount. Now finally bank balance is calculated, which is positive balance. It is recorded in the asset side. Assets and liabilities, remaining asset liabilities recorded, and we got the balance sheet tallied. So in these simple steps, take the screenshot if you want. In these simple steps, you can tally the problem, that is the question of admission of partner easily. Now the question is, can we use the same steps for retirement and death of partner? The answer is yes, you can. You have to use the same steps. As you can see this question, A, B, C are partners. General reserve is given, loan, creditors, bills payable, other liabilities. Then building, car, furniture, investment, debtors, BR, stock, preliminary expenses, fictitious asset, and bank. So C is retired from the firm. Past profits are given. Then building appreciation, car reduction, investment taken by B, bills payable taken by A. The revaluation expense, goodwill of the firm is valued at 6 lakh. Goodwill to be adjusted through capitals only. So raise return of a net effect. New profit sharing ratio will be 1:1. 60% of claim of C is to be paid immediately. Balance kept as 14% loan. 14% is the interest rate. Capital balance to be in the new ratio based on A. So let's go for the same steps again. Prepare revaluation account, bank account, then new balance sheet and capital accounts. Record balances. Transfer general reserve to all partners in old ratio, that is old partners in old ratio. Same way preliminary expenses debited. Then now the only difference in earlier steps, that is admission and retirement, is nothing to bring in. So skip that step. New cash brought in by new partners, skip it off. Then make the revaluation of assets and liabilities. Car reduced, investment reduced. Then building appreciated, bills payable reduced. Then bills payable is taken over by A, so it is credited to A's account. And I guess something investment is taken by B at 80%, so it is given to B and debited to B's account. Then record revaluation expenses as it is, so nothing is new. Revaluation account debit to bank. Thereafter find out the new ratio, it is already given. Make the goodwill adjustment then. So goodwill raise and return of raised old partners in old ratio as we did earlier. Here ABC 3 partners were new and A and B are only new partners. So they want net effect. So just give the net effect like goodwill cancelled. Then A was 3,60,000 credit and 3 lakh debit, so 60,000 credit. Then C 120 credit and nothing debit, so 120 credit. And B's account 100% debit 3 lakh, that is 3 lakh, and B 120, that is 180. So entry will be B account debit 180 to A's account to C's account. So that will be recorded in the capital account, debit of B's capital and credit of A and C's capital. Once it is done, revaluation profit loss you can transfer to old partners in old ratio, that is all the partners ABC will get this revaluation loss that is transferred. So everything was same. What is new? Now the question is, or the point is, when any partner retires or if there is any death of partner in between of the year. See here the balance sheet is on 31st March and retirement date is 1/11/21. That is after 3 months. In that case, you will claim the profit for 3 months and that is for 3 months. It will come here. And then he will claim the profit. He said for 12 months, last year profit was 6 lakh. For 3 months, it will be 1,50,000. So 1/4 share, I want 37,500. So directly also we can go for this. That 6 lakh rupees last year's profit into months of servicing current year is 3 months by 12 and 1/4 is the profit sharing ratio. Now this 37,500 is to be credited to C's account because we must get that amount. So it is debited to P&L suspense because ideally it should be debited to P&L account, but we don't have P&L account in between the year. So P&L suspense asset side. So where will I record this? I will record P&L suspense account in the asset side 37,500 and second effect his capital account credit side 37,500. Okay. Then his account is to be settled. So I found his balance. It comes 4,07,625 balancing figure, of which 30% paid, 70% kept as loan. So 30% paid, second effect bank credit, and 70% kept as loan. So it will be 14% C's loan account liability side. If it is death, simply you have to write executors of C's loan account, nothing more than that. Then comes one more adjustment, expected closing at balance. So he said my closing balance, A said my closing balance is 46,250 and ratio is 3. For 2, you should keep 30,833, just like earlier we have done. So it is recorded in the liability side as well as in the capital account debit side as two balance brought down. Sorry, two balance carried down. Then balancing figure of B is transferred to bank account. Balancing figure brought in by him. Second effect, bank account debit. Now the capitals are over. Revaluation account is closed. Bank balance will go to the balance sheet. And A and B are the only partners now. Their capital is recorded. Remaining assets and liabilities recorded. And we got it tallied. In short, 80% of the solution of retirement or death is similar to admission of partner. Just that you have to go for one new adjustment, that is proportionate profit to be given. And instead of bringing the cash as capital, you have to make the repayment. So in this way, we have revised admission, retirement and death in this video. Thank you. Best of luck. पढ़ते रहो, आगे बढ़ते रहो. Bye.